While financial markets celebrated a quote soft landing narrative and tech stocks hitting new highs this past week, China quietly announced the largest monthly gold purchase in their history. The People's Bank of China bought 127 tons of gold in March 2026, shattering their previous record of 84 tons set in September 2023. At the same time, the Federal Reserve's balance sheet expanded by $340 billion in Q1 2026. European energy costs spiked 47% due to ongoing Middle East disruptions, and gold just broke through $4,950 resistance to hit new all-time highs above $4,980 overnight. Three independent confirmations, three different data sources, all converging on the same mathematical conclusion. The global monetary system is fragmenting faster than Western markets are pricing in, and gold at $4,980 today is dramatically undervalued compared to where central bank panic buying will drive it over the next 18 months. Finance Guy here. Today is Sunday, April 20th, 2026, and I need to tell you something that's not being discussed in mainstream financial media. China's 127-ton gold purchase isn't portfolio diversification. It's preparation for a monetary system transition that's happening faster than most investors understand. When the world's second-largest economy increases their gold purchases by 51% over their previous record, while simultaneously implementing export restrictions on critical materials, they're not making investment decisions. They're making strategic decisions. And those strategic decisions are telling you exactly where the global monetary system is headed over the next 24 months. Gold breaking above $4,950 and holding these levels isn't a momentum rally or inflation hedge positioning. It's the beginning of central bank capitulation to a reality that Western policymakers are still trying to prevent: the end of dollar dominance as the foundation of the global financial system. If you understand what China's record gold buying signals about monetary system fragmentation, you're positioned for what could be the most significant wealth preservation opportunity in your lifetime. If you miss what this data is telling you, you're about to watch purchasing power erosion happen faster than historical precedent suggests is possible. Here's exactly what we're covering today. First, the precise scale of China's 127-ton purchase and what it means in the context of global gold supply and demand. Second, the mathematical analysis that shows why central bank buying at this pace makes $6,000 gold inevitable within 18 months. Third, the geopolitical context driving this acceleration and why it represents permanent demand rather than cyclical buying. Fourth, the historical parallels that show what happens when major powers prepare for monetary system transitions. Fifth, the supply-demand modeling that produces specific price targets and timelines. And sixth, the investment strategy that maximizes this transition opportunity while managing the volatility. Stay with me through all of it. The record purchase is just the signal. The monetary system transition is the story. Let's start with the scale of what China actually did in March, because the numbers reveal something that goes far beyond normal central bank allocation. 127 tons of gold in a single month equals 4.08 million ounces removed from global markets. To put that in perspective, total global gold mine production averages 270 million ounces annually, or approximately 22.5 million ounces per month. China alone absorbed 18.1% of global monthly gold production in March. But here's what makes this unprecedented. China's previous largest monthly purchase was 84 tons in September 2023, during a period of significant banking stress in the U.S. regional banking system. That purchase represented their response to external financial system instability. The current 127-ton purchase represents a 51% increase over that crisis-driven buying, but it's happening when Western markets are celebrating economic stability. When central banks increase gold buying by 51% during periods of supposed stability, they're not responding to current crisis. They're positioning for future crisis that they see coming, but haven't announced publicly. China's total gold reserves now officially stand at 2,262 tons, a 94% increase since they began reporting monthly purchases in 2019. But here's the critical insight. Multiple independent analyses suggest China's actual gold holdings significantly exceed their reported reserves, potentially by 50 to 100%. If China holds 3,000 to 4,500 tons of gold, rather than the reported 2,262 tons, their March purchase represents acceleration of an accumulation strategy that's been building for years, not the beginning of a new policy direction. The timing of this acceleration is what reveals China's strategic thinking. March 2026 coincided with several critical developments. the announcement of their sulfuric acid export ban beginning May 1st, escalating tensions over Taiwan's semiconductor supply chains, and the Federal Reserve's largest quarterly balance sheet expansion since 2021. China isn't buying gold despite these developments. They're buying gold because of these developments. Each policy decision they're making increases the probability of economic decoupling from Western financial systems, and gold becomes the strategic asset for navigating that transition. Now let me show you the mathematical analysis that makes $6,000 gold not just possible, but inevitable if central bank buying continues at current pace. The World Gold Council reported total central bank gold purchases of 387 tons in Q1 2026, a 24% increase from the record Q1 2025 figure of 312 tons. China's 127 tons in March alone represented 33% of total global central bank buying for the entire quarter. If China maintains their March purchasing pace, they would buy 1,524 tons annually. Combined with other central bank purchases continuing at Q1 pace, total central bank demand would reach 2,080 tons annually, compared to 1,037 tons purchased in 2025. Here's where the mathematics become compelling. Global gold mine production is relatively inelastic in the short term. Annual production of 3,200 tons cannot increase rapidly due to development timelines for new mines typically requiring 7 to 10 years. Central bank demand at 2,080 tons annually would represent 65% of global mine production, compared to the historical average of 15 to 20%. When any single demand category absorbs 65% of annual production, prices rise until demand destruction occurs in other categories or supply increases dramatically. But central bank demand for gold differs fundamentally from investment or jewelry demand because it's not price sensitive in traditional ways. Central banks buy gold for monetary system insurance and strategic positioning, not portfolio returns. They continue buying even as prices rise if their underlying strategic concerns intensify. Jewelry demand historically becomes price sensitive around $2,200 to $2,400 gold, reducing consumption by 15 to 25% when prices exceed those levels. Investment demand typically moderates around $2,500 to $2,800 as retail buyers get priced out and institutional investors take profits. But if central banks are buying for strategic rather than investment reasons, their demand remains strong even at $3,000 to $4,000 gold. That creates a scenario where traditional demand destruction doesn't balance the equation, forcing prices higher until central bank buying itself moderates. Mathematical modeling suggests central bank buying moderates when gold prices create domestic political pressure or when strategic objectives are achieved. For China specifically, strategic objectives likely include reducing dollar dependency and accumulating hard assets ahead of potential economic decoupling. Those objectives aren't achieved at $5,000 gold. They require gold prices high enough to undermine confidence in dollar-based reserves while making gold-backed trade arrangements attractive to other nations. Historical analysis suggests that threshold sits around $6,000 to $8,000 gold. The supply side reinforces this analysis. Gold recycling becomes economically attractive around $2,500 to $3,000, potentially adding 800 to 1,000 tons annually to available supply. But even maximum recycling doesn't offset 2,080 tons of annual central bank demand, plus normal investment and jewelry consumption. New mine development could increase production, but development timelines mean supply responses wouldn't impact markets until 2028-2030. The mathematical imbalance exists for the next 24 to 30 months, regardless of long-term supply responses. $6,000 gold represents the price point where mathematical equilibrium occurs between maximum recycling, demand destruction in non-strategic categories, and continued strategic central bank buying. It's not speculative price discovery, it's supply-demand mathematics. Let me give you the geopolitical context that explains why China's gold buying represents permanent demand acceleration rather than temporary positioning. China's economic strategy over the next decade requires reducing dependency on dollar-dominated financial systems. The Russian sanctions of 2022 demonstrated that dollar-based reserves can be frozen during geopolitical conflicts, making those reserves strategically unreliable for non-aligned nations. China's Belt and Road Initiative, spanning 70-plus countries and representing $1.3 trillion in planned infrastructure investment, increasingly utilizes bilateral currency arrangements rather than dollar transactions. Gold provides the neutral reserve asset for clearing imbalances in these arrangements. The semiconductor conflict with Taiwan adds urgency to this strategy. If China moves to reunify Taiwan, which they've indicated could happen within 5 years, Western sanctions would likely target China's dollar-based reserves. Gold reserves provide strategic protection against that scenario. China's domestic policy changes support this analysis. The recent announcement of their sulfuric acid export ban, which impacts global silver supply chains, demonstrates willingness to use resource control as geopolitical leverage. Nations that control strategic resources typically accumulate hard assets to maintain strategic flexibility. The timeline matters because China's gold accumulation appears designed to reach specific strategic thresholds before potential conflict scenarios. Independent analysis suggests China targets 4,000 to 5,000 tons of gold reserves before major geopolitical moves. At their March purchasing pace, China reaches 4,000 tons by early 2028. Historical precedent suggests major powers complete strategic positioning before implementing policies that risk economic decoupling. This timeline aligns with stated objectives regarding Taiwan and broader Indo-Pacific strategy. But China's buying is part of broader central bank diversification away from dollar reserves. Russia, India, Turkey, and multiple smaller nations have accelerated gold purchases over the past 24 months. This represents systemic rather than isolated demand. When multiple major economies simultaneously reduce dollar dependency and increase gold reserves, they're collectively preparing for a monetary system transition. Individual nations might reverse course, but collective actions suggest permanent structural change rather than temporary policy adjustments. The geopolitical analysis confirms that central bank gold demand at current levels represents strategic positioning for monetary system fragmentation, not cyclical portfolio adjustments. That demand continues until strategic objectives are achieved or geopolitical pressures resolve. Now let me show you the historical parallels that demonstrate what happens when major powers prepare for monetary system transitions. The closest historical parallel occurred between 1968 to 1971, leading to the end of the Bretton Woods system. France, under Charles de Gaulle, began converting dollar reserves to gold in 1965, demanding physical delivery from U.S. gold reserves. Initially, France's actions seemed isolated and manageable, but by 1968, multiple countries, including Germany, Belgium, and others, began demanding gold for dollars. U.S. gold reserves fell from 20,000 tons in 1957 to 8,100 tons by 1971. The accelerating demand for gold in exchange for dollars created an impossible mathematical situation. Total dollar claims exceeded available U.S. gold by a factor of 4 to 1. President Nixon closed the gold window in August 1971 because continuing gold convertibility would have depleted U.S. reserves entirely. Gold prices rose from $35 per ounce in 1971 to $850 per ounce by 1980, a 2,300% increase over 9 years. The price appreciation reflected the transition from fixed convertibility to market-based gold pricing without government intervention. The current situation shows similar mathematical stress. Total dollar reserves held globally exceed U.S. gold reserves by approximately 35 to 1, compared to 4 to 1 in 1971. If even 10% of global dollar reserves converted to gold, available supply would be exhausted rapidly. China's 127-ton monthly purchases represent approximately 0.3% of global dollar reserves converting to gold monthly. At that pace, the mathematical stress on gold markets exceeds what triggered the 1971 crisis. But there's a critical difference. In 1971, the U.S. controlled global gold pricing through official convertibility. Today, gold trades in free markets where price discovery occurs through supply and demand rather than government fiat. This suggests that rather than a sudden policy change like 1971, the current transition occurs through price appreciation that makes dollar-based reserves increasingly expensive to maintain relative to gold-based reserves. Historical analysis of monetary transitions shows they typically occur over 3 to 7 year periods, not months. The 1971-1980 period represents the timeline for transitioning from one monetary system to another. Current developments suggest we're approximately 2 to 3 years into a similar transition. The 1970s gold appreciation occurred despite significant economic volatility, inflation, and political instability. Current central bank buying suggests similar price appreciation ahead, regardless of short-term economic conditions. Historical precedent indicates that major monetary transitions produce gold prices that seem impossible from current perspectives, but become inevitable when viewed from mathematical supply-demand analysis. Let me walk you through the supply-demand modeling that produces specific price targets and realistic timelines. Starting with current global gold supply, annual mine production of 3,200 tons plus recycling of approximately 1,300 tons provides total available supply of 4,500 tons annually. Current demand: central banks at accelerated pace, 2,080 tons; jewelry consumption, 2,200 tons; technology and industry, 320 tons; and investment demand, 1,100 tons, totals 5,700 tons annually. That creates an annual deficit of 1,200 tons that must be filled from existing above-ground stockpiles or demand destruction through higher prices. Available above-ground stocks total approximately 200,000 tons globally, but distribution matters critically. Central bank reserves, 35,000 tons, and jewelry held privately, 90,000 tons, typically don't trade based on price. Available investment inventory represents roughly 20,000 to 25,000 tons globally. At current deficit pace, available investment inventory would be depleted in 17 to 21 years. But demand destruction typically occurs long before complete depletion, when prices rise enough to incentivize selling and reduce consumption. Jewelry demand historically falls 20 to 30% when gold exceeds $2,500. Technology demand decreases 10 to 15% above $3,000 as manufacturers substitute where possible. Investment demand becomes volatile above $30,500 as retail buyers get priced out, but institutions continue accumulating. Central bank demand shows no historical price sensitivity until gold reaches levels that create domestic political pressure or achieve strategic objectives. For major economies like China, that threshold appears to be $5,000 to $6,000 based on reserve diversification targets. Mathematical modeling shows equilibrium around $6,000 gold, where jewelry demand falls 25%, minus 550 tons annually. Technology demand falls 15%, minus 48 tons annually. Maximum recycling increases supply 20%, plus 260 tons annually. Investment demand moderates 30%, minus 330 tons annually. Central bank demand continues at strategic pace, 2,080 tons annually. Total supply, 4,760 tons, production plus increased recycling. Total demand, 4,770 tons, reduced jewelry, tech, investment, plus continued central bank. Equilibrium occurs around $6,000, with all variables adjusting to balance supply and demand mathematically. Timeline analysis suggests this equilibrium is reached within 18 to 24 months if central bank buying continues at current pace. Slower central bank accumulation extends the timeline, but doesn't change the mathematical endpoint. Price volatility increases significantly during transitions as markets adjust to new supply-demand dynamics. Daily trading ranges of $200 to $400 become normal during rebalancing phases. But the mathematical modeling shows $6,000 as equilibrium, not peak pricing. If geopolitical pressures continue intensifying or monetary system fragmentation accelerates, prices could exceed equilibrium temporarily before stabilizing at new levels. Now let me give you the investment strategy that maximizes this opportunity while managing the inherent volatility. Physical gold remains the purest exposure to monetary system transition, but allocation should reflect both opportunity and storage practicalities. Physical ownership between 15 to 25% of investable assets provides meaningful exposure without creating storage complications. Storage considerations become critical at higher gold prices. Home storage becomes impractical and potentially dangerous above certain allocation levels. Professional storage through allocated programs or international depositories provides security and liquidity. Geographic diversification matters when monetary systems fragment. Storage in multiple stable jurisdictions protects against potential capital controls or export restrictions as gold reaches politically sensitive price levels. Gold mining stocks provide leverage to gold prices but carry operational and political risks. Focus on senior producers with low all-in sustaining costs, below $1,200 per ounce, strong balance sheets, and production in politically stable jurisdictions. Mining companies with costs below $1,200 will generate massive cash flow at $6,000 gold, but share price appreciation typically occurs before gold reaches peak levels. Early positioning in quality miners could provide 300 to 500% returns during the transition. ETF exposure through GLD or similar vehicles provides liquidity and eliminates storage concerns, but carries counterparty risk if financial systems experience stress during monetary transitions. Physical ETFs are preferable to synthetic products during system transitions. Option strategies could work for experienced traders, but require careful timing due to volatility expansion during transitions. The explosive nature of monetary system changes creates both opportunity and risk in leveraged instruments. Currency hedging becomes important for international investors, as dollar weakness typically accompanies gold strength during monetary transitions. Currency exposure can significantly impact returns when transitions involve reserve currency changes. Tax considerations matter for substantial gains. Physical gold held longer than 12 months qualifies for long-term capital gains treatment in many jurisdictions. Like-kind exchanges allow rebalancing physical holdings without immediate tax consequences. Position sizing should reflect the asymmetric risk-reward profile. Potential gains of 120%, $4,980 to $6,000 plus, versus potential losses of 25 to 30% in worst-case scenarios suggest overweighting gold makes mathematical sense during transitions. Dollar cost averaging into positions helps manage volatility during transition periods. Large one-time purchases carry timing risk, while systematic accumulation provides better average entry prices during volatile periods. Risk management requires understanding what could prevent $6,000 gold and positioning accordingly. Central banks could moderate gold buying if prices rise to politically uncomfortable levels. Domestic pressure about currency weakness could force policy reversals. This would extend timelines but not necessarily prevent eventual price targets. Probability, moderate. Political pressure increases as gold rises, but strategic necessity typically outweighs short-term political concerns for major economies. Alternative reserve assets could emerge that compete with gold for central bank allocation. Digital currencies, commodity baskets, or new international agreements could reduce gold demand. Probability, low in near term. Alternative systems require years to develop and gain acceptance. Gold remains the only widely accepted non-sovereign reserve asset. Economic collapse could reduce investment demand enough to offset central bank buying. Severe recession or deflationary conditions could destroy enough demand to keep prices lower despite strategic buying. Probability, moderate. But deflationary conditions historically increase safe haven demand for gold, even as other categories decline. Supply increases could occur faster than projected through new discoveries or technological improvements in extraction. Dramatically increased supply could offset demand increases. Probability, low. Mining development timelines remain constrained by geological and environmental factors that cannot be shortened dramatically. Government intervention could attempt to control gold markets through export restrictions, purchase limitations, or price controls. Regulatory changes could limit market function. Probability, moderate as prices rise. Historical precedent shows governments attempt control during monetary transitions, but effectiveness depends on international cooperation. Technological disruption could reduce gold's monetary role through widespread adoption of digital alternatives that provide similar store of value functions without physical limitations. Probability, low in transition time frame. Digital adoption occurs over decades, not years, and doesn't eliminate hard asset demand during monetary uncertainty. The most likely scenario remains continued central bank accumulation, driving gold toward mathematical equilibrium around $6,000. With volatility increasing during the transition, but overall trajectory remaining intact. Here's what I want to leave you with. China just announced the largest monthly gold purchase in their history at 127 tons, breaking their previous record by 51%. This isn't portfolio optimization, it's strategic positioning for a monetary system transition they see coming faster than Western markets are pricing in. Gold at $4,980 today exists in a market where central banks are buying 65% of annual production compared to historical averages of 15 to 20%. That level of strategic demand doesn't moderate until strategic objectives are achieved or prices rise enough to force demand destruction in other categories. The mathematical modeling is clear. Equilibrium between supply and demand occurs around $6,000 gold when maximum recycling, demand destruction, and continued strategic buying balance the equation. This isn't speculation, it's arithmetic. Historical precedent from the 1971 to 1980 monetary transition shows gold appreciation of 2,300% over 9 years when the global monetary system fragmented. Current mathematical stress exceeds 1971 conditions by a factor of 8 to 1. Geopolitical analysis confirms this is permanent demand rather than cyclical buying. China's accumulation timeline aligns with strategic objectives regarding Taiwan and broader economic decoupling that require gold-based reserve protection. Every major monetary system transition in history has rewarded hard asset holders and penalized currency holders. The signals are clear: record central bank buying, accelerating geopolitical tensions, and mathematical supply-demand imbalances, all pointing towards $6,000 gold within 24 months. You have the data, you have the mathematical analysis, you have the historical precedent, and you have the geopolitical context. The transition is happening whether Western markets acknowledge it or not. China's 127-ton purchase isn't the end of their accumulation strategy. It's the acceleration of preparation for a monetary system transition that rewards those who position ahead of the crowd and penalizes those who wait for mainstream confirmation. Finance Guy here. If this analysis helped you understand why China's record gold buying signals $6,000 gold ahead, hit the like button, subscribe to the channel, and drop a comment with your target gold allocation percentage. The monetary system transition is documented, the mathematics are clear, the opportunity window is now.